Pledge of allegiance, please.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation under God, indivisible, with liberty and justice for all.
Good Lord.
Patriotic enthusiasm.
We have a roll call, please.
Okay, Councilmember Bozick.
Here.
Councilmember Rivas.
Here.
Councilmember Conover. Present. Councilmember Graham.
Here.
Councilmember Jessen.
Here.
Councilmember Larson.
Here.
Councilmember Witten.
I am here.
Commissioner Good. Commissioner Blaney. Present. Commissioner Biggs. Advisory member Matt Beckley. David Stiles. And Mark Christie.
Here. Okay. Very, very good. Welcome, everyone, to this evening's foundation meeting. And first thing we have on the agenda is approval of the minutes.
I'm going to say motion to approve.
Motion on the floor, then a second to approve the foundation minutes for February 27th, 2018. Any discussion? Seeing none, all those in favor signify by saying aye.
Aye.
All those opposed? Motion carries. And then that moves us right into Capital City's presentation. Are you solo tonight?
You are stuck with me.
Okay.
That answers your question, Jeremy.
Thank you. So, she is booting up the presentation there. If you go to the considerations and observations page, so we do projects on a quarterly basis throughout the year. In this meeting, even though we're 4 days away from the end of the second quarter of 2018, we're here to cover the first quarter 2018 results. And along with that, we've done a fee analysis to show you basically the fees that you pay for the various services that you're provided from not only my firm, but also the money managers and the custodial relationship that we have with Schwab. A couple just items of note, the externally held bonds that we do not hold at Schwab, you get basically two payments a year. They come in July, August, and January, February. There were a couple of payments made and deposited in the first quarter. $2.7 million in principal was received and deposited in the Schwab account in January. We had a fund change. If you recall, there was a cheaper share class available at Schwab for one of the passive managers, and we were able to save about a half of a basis point, so we made that change. That actually took place at the beginning of December. And then on February 14th, we sent you a Valentine's Day card with your 2017 distribution of just under $6.8 million. So those are kind of some operational issues, and I'll go over the fee analysis when we get through the report. If you'll.
Can I ask you one quick question?
Yep.
You say that as of this report, the bonds total $1.2 million. Are you talking today, or are you talking March 31st?
It would have been March 31st. Okay. Yeah, and that information is back on page 21, I think.
Okay, there's just 4 remaining municipal bonds?
Correct. You've got 2 Town of Chesterton and 2 City of Portage on page 21.
Oh, thank you.
So if you'll go to page 1 of the report then, which is the bar charts there. So the first quarter we saw volatility enter back into the marketplace. We had a good 2017, and we started out in January with a good January, but in February and March we saw the S&P 500 retreat about 8%. You saw volatility creep in. There were movements of 2% or more in the S&P 500, I think 6 or 7 times, and that didn't happen once in 2017. So the volatility obviously impacted returns. We saw Jerome Powell as the new chairman of the Fed, and in his first meeting, raised rates 25 basis points a couple weeks ago. They had another 25 basis point raise. So obviously you're a 40% equity, 60% fixed income portfolio. When rates rise, it impacts fixed income in a negative fashion generally, and so returns were hard to get in the marketplace in the first quarter. You can see, as represented in the bar charts on page 1, you've got equity returns and fixed income returns. The blue represents the quarter. The gray represents the trailing 12 months. Equity returns were mixed. You saw growth stocks, both in the small and large space, have positive returns. You saw primarily negative returns across most other equity styles. Emerging markets actually had a slight positive return as well. And in fixed income, results were mostly negative. And obviously you have a larger allocation to fixed income within the foundation. The falling dollar helped non-dollar stocks. You can see that most returns across the fixed income styles, as portrayed by the bottom bar chart there, are negative. Non-dollar stock or non-dollar fixed income did reasonably well because of the falling dollar at just over 4% in its return. So the ag, the broad bond market here domestically was down about 1.5%. So on page 2 of the report, what did that mean for the foundation? Well, we had a negative return of about 50 basis points for the quarter. You've rebounded here in the second quarter. As of Friday, we had a rough day yesterday, but as of Friday, you were up about 1.5% for the quarter, but you had about a 50 basis point loss in the first quarter of 2018. Over the past year, the return in the portfolio is just over 7%. As of Friday at the close, you have $156,466,720, and that includes the external bonds.
Joe, could you repeat that on the first quarter? Of course, we lost 0.5%.
Yes.
And then so far for the second quarter?
Through Friday.
You
were up 1.5%.
Up 1.5%.
Yeah.
So anything that we lost in that first quarter that's reflected in this report we've regained.
You've regained. Outside of yesterday, we were down about 300 points, obviously, but you're only 40% in equities, so you didn't get all of that, downward loss in the market yesterday. But,
and then you said that it was 156?
156,466,720. If you go down to the stoplight grid, we're happy with what all the managers are doing. You can see the Carillon Reams Core Plus Manager has a white background. That means that it changed from yellow last quarter to green. If you'll recall, Reams is based out of Columbus, Indiana. They sold to Carillon Towers. They're a subsidiary of Raymond James. From an organizational standpoint, the team in Columbus have long-term contracts. We put it on yellow just to watch to see if there were going to be any negative results from the organizational change. There are not. We're comfortable with things, so we changed it back to green, and that's why the white background is signified there. On page 6 of the report, just from the inception, your cumulative return for the portfolio is about 15.5%, 15.6% since we first invested the dollars. So happy with how the markets have treated the portfolio.
Yeah, and as you guys may recall, I mean, that's why we had that whole holding fund and to try to build up a little bit of reserve for the quarters when we didn't have bumper crops, as we say. So
protect ourselves from the volatility that we're seeing
Right.
that we saw in the first quarter.
Right. So that really covers the report. If you'll flip past the second tab, We do projects that really help you from a fiduciary standpoint, answer to your constituency that you're handling your fiduciary responsibilities prudently. One of the things that you're charged with is making sure that you pay fairly from a fee perspective for the various providers that are involved in the portfolio. On page 2 of the fee analysis, so we utilize an open architecture environment. It's in the institutional world, it's the best approach that you take because it provides transparency for the services and the fees that you're being provided by the different vendors involved. That includes us, the investment consultant, Capital Cities, the custodian, which is Schwab, and then the various investment managers that we have in the portfolio. So those are going to be reflected in here, the pages that follow. But on page 3, the way that we kind of look at this, we ask ourselves the question, first of all, are the overall investment management fees reasonable? So we utilize a combination of active managers and passive managers. So we have index funds that are just passive in nature, and then we have active managers that are actually on a day-to-day basis making trading decisions in the various styles for which we hired those managers. Are we utilizing the least expensive share class? Fees are very important in today's world of investing, and so we're always watching for whether there's a new share class that might be available that might be cheaper. And there actually have been a couple that we've been, over the past year, able to recognize and change out and allow for fee savings on your behalf. The Loomis Sales Strategic Alpha Fund, they lowered their share class fee from 75 to 68 basis points. On an annual basis, that's about a $6,300 savings for the foundation. The Harbor Capital Appreciation Fund was lowered from 65 to 57. That change was made. That represented about a $9,500 savings over a 12-month period of time. And then the S&P 500 change that we made from Vanguard to Schwab was about a half of a basis point, so it was kind of negligible in fee savings, but it was still fee savings. So, and then we are looking right now, the Western Total Return Unconstrained Fund has a new share class. It's not yet available to foundations. It's been available to retirement funds. We're working with Schwab right now to see if we can make it available to our foundation clients, and it would save 10 basis points on that particular allocation for the Western Unconstrained. And then, are the fees reasonable? And we're going to show you here in a second relative to peers what those fees look like. So if you'll turn to page 4, let's look at equity first. We've got the different equity managers there listed. As I indicated, we have passive and active managers there. We show the name of the fund, the peer group against which they're measured, the fee schedule you're paying, and then kind of the percentile relative to peers. You're on all managers lower than your peers, with the exception of William Blair, and you're 5 basis points above the median there. So we're comfortable with the fact that you're paying fair and reasonable fees across the equity style.
Joe Bill, can you explain a little bit about how those basis points, we are better than the median on all but the one, but what creates the variance? What changes those basis points?
It's just how each management company chooses to value their fees that they're charging to clients. And so we're looking at, for example, the Harbor Capital Appreciation, we're looking at all large company growth managers and what they charge across the landscape of large cap growth managers. And, they range from 180 basis points, down to 63 basis points. Your managers are falling somewhere in between, but they're all below the median.
Gotcha.
Along that vein, this may be a loaded question, understanding our equities limitations, but how was our first quarter in comparison to our peer group? How did we do across the board?
Well, so it's difficult to
And I understand
compare you relative.
yeah, we have those restrictions and
Well,
limitations.
it's because allocation drives your performance.
Right.
So the peer group against which you're compared is foundations that are generally around $100 million in size. And the allocation of the peer group is closer, from an equity perspective, to 55%, and you're 40. So you're not going to look good against a peer group just because you're more conservatively allocated, unless the markets are, really bad in the equity space. So it's difficult to do a peer group comparison because allocations drive performance.
Right.
But at 50 basis points and a negative return, I can tell you our other foundation and endowment clients were down somewhere between 80 and 90 basis points for the quarter.
All right. Thank you.
Are these fees based on the amount of work that they're doing on our account, or is this,
So you're utilizing mutual funds.
right?
So these are all based on what they do for any investor who might be commingled in the account with you. But it's set by the fund company, and it's based on the type of work they're doing. So passive managers are much cheaper because you're just buying basically a computer that's choosing the stocks to mimic an index. Active managers are going to be more expensive because they require greater resources from a staff standpoint to do the due diligence on the companies that they plan to buy. And when you get into small companies in the active space are going to be more expensive than large companies because large companies are considered an efficient market and the information is readily available. Smaller companies, you're going to have to do more research on the stocks that might be available. International, even more expensive because it requires greater resources to look at the companies, across the globe.
Okay, thank you.
If you go to page 5, in the fixed income space, the same is reflected here from a standpoint of the funds that we're utilizing, the peer group against which they're being measured, the fees that you're paying, and you can see that you're well below, across all the fixed income managers, below the median fee that you would pay if you were to go out and find a median fee manager.
You'd mentioned that Western unconstrained was maybe 10 basis points lower.
So they have a share class that's not available to you as a foundation yet. We consult to $25 or $26 billion, so we have some leverage with Schwab, and we're trying to use that leverage that we have to say, hey, you need to make this available to our foundation clients as well. If we're successful in that negotiation, it'll be 10 basis points lower than what you're currently paying. On page 6, the custodial fees, you're at Schwab. Schwab doesn't charge a fee other than transaction fees. So you paid $140 last year in transaction fees. So you effectively are paying zero cost for custodial fees. And then our fees are on page 7. Our fees include not only just coming here to these quarterly meetings and reporting performance, but on an ongoing basis doing these projects like the fee analysis. We'll do a portfolio construction evaluation on an annual basis. We're always looking at investment managers doing due diligence on an ongoing basis. If we have to replace one, we'll do a search, and that's all inclusive in our fees. Investment policy statement review, we'll come and do that on an annual basis. So basically, our fee is $65,000. It's flat, and it's a full retainer relationship. So we don't charge you for travel or anything like that. It's just all inclusive on an annual basis. So what's that mean across the board then on page 8? So on page 8, you're paying 44 basis points for manager fees across both equity and fixed income management. effectively 0 for custody fees and 4 basis points to us for the consulting fees. So your total fees are under 0.5%, which we think is very reasonable when you look at fees on an account as large as yours. You know, the Department of Labor, if you were to look at what they say, you should get fees to at least somewhat mimic, is you need to be under 1%. So you're under 0.5%. So we're comfortable with the fees that you're paying and the services you're being provided. So
The fees are a whole lot easier to swallow when we're actually making money,
yes,
too.
that's true. And it's a whole lot easier to fire me when you're not, so.
Which brings us to the next thing on the agenda.
Hey, Joe Bill, on the fees, and I appreciate you, of course, your focus on it, which it is important to us, and we've had some success in lowering the fees in several of the funds. Have any of the fees increased on
No.
the funds?
No.
So we're not just solely listing the reductions? I mean,
No.
And have we ever experienced any increases?
No. If we saw increases in fees, it would send a red flag up for us, and we would
We
probably
get
look for
different-
another manager who could do something equally as good and fit in the portfolio equally as well that would do it for cheaper. We're not about raising fees.
So I have a question on the fixed income. Are you tracking weighted average duration for the portfolio? And if so, do you know where we are right now?
I can't answer that off the top of my head, but yes, my research team would have a good idea based on the mix of fixed income managers you have, what that would be, and I'm happy to get that information.
I'd appreciate that. And I'm assuming the unconstrained funds, as they're listed in here, means that they can take a variety of actions to manage
Correct.
duration.
Yes, yeah, correct. So they're looking across the globe at the interest rate environment, and they have they're not being managed, they're not being benchmarked against an index. We're giving them the flexibility to say, here's where we think from an interest rate standpoint the best opportunity lies, and we give the manager that discretion. I'll give you my card as I walk out, and you send me your information, I'll get that question answered.
Joe Bill, if you could just send that answer to Joy,
Yep.
and then she'll disseminate it to everybody,
Okay.
that would be great.
Okay, great. That's all I have.
All right, yeah, that's fantastic, man.
Okay.
Thanks.
Any
Great news.
additional questions for Joe Bill before he leaves? No? Okay, very good, thanks so much.
Thank you.
So I guess I suppose at our next meeting, or certainly when we get into our budget sessions from the council's perspective, we're going to have some conversations of where we're at on earnings this year and how we have in our how much we have in our capital holdings, and make some adjustments, would be my suspicion.
Along those lines, who would you like to submit the foundation budget?
I think that,
Or do you, I believe, the life? Thank you.
Mr. President?
I'd say you and I will work on that.
All right.
Dan and I will take care of it.
Okay.
Well, at our council meeting, we sent out a firm letter that they be on time, so I suggest you two have that budget in on time.
Yeah, but
I
the
believe-
repercussion is that we just go to the year before. So, we'll take it.
Okay, any other comments on the capital cities?
Now more than ever, we just have to, like I said, I hate to keep reiterating, but when we were doing, when the market was better, it was a question of how much was going into our capital holdings fund, but now, or rainy day fund, or whatever you want to call it. But now that we're seeing some more volatility in the market, I think we have to really be having a lot of conversations collectively, commission and council, as we move through in predictions and expenditures in the future and that sort of thing.
And it helps validate, the first quarter helps validate the need for the rainy day fund, right?
Yep.
Oh, absolutely.
Not as much fun.
Nope.
Okay, attorney's report. Harold? Scott?
We don't have anything at this point tonight to, we talked about the audit.
underway, we're cooperating with whatever they're requesting, and
Well, that's good news.
we'll keep you posted if there's anything that
Or if you decide to not cooperate, let us know.
we would also, let you know.
Is there a date when they're anticipating being completed with that audit? As we,
I'm aware of at this point.
At this point, do you, I mean, you don't, have to, I guess maybe tell us now, but do you see any issues with the audit? Have we found any things that have been problematic that we should know about?
Nothing that's been brought to our attention yet.
Awesome.
Vicki, I know you've been involved with information gathering and analyzing. Do you have anything that you'd like to add relative to the audit?
No, we're still in the gathering of the information phase, but I sent them a number of documents. And we
Any other matter that may properly come before the board? If not, a motion to adjourn?
Hey, I'm going to make that motion.
Second. A motion on the floor to adjourn. All those in favor signify by saying aye.
Aye.
All those opposed?
No.
Any opposed?